Good afternoon. Welcome into the Tuesday, November 10th, 2020 edition of Market Talk. I'm your host, Jesse Allen. Thank you for joining us. You can find us online, markettalkag.com, and also via social media, Facebook, Twitter, Instagram, and on all your favorite podcast sources as well, including Spotify, Apple Podcasts, iHeartRadio, radio.com, and much more. WASDE report out for November today. Some big surprises there. We saw the markets close higher, especially in soybeans and corn. And let's talk about it. We'll bring in our guest with us here today. He's with agmarket.net. Jim McCormick is joining us. Jim, how are you today?
Good. Thank you for having me, Jesse. And you had me on a great day. We had definitely a bullish surprise on these WASDE numbers, and it is exciting, plain and simple.
Yeah, it is very, very exciting. Let's start right there with this WASDE report. Lower than expected ending stocks estimates from USDA on the corn and soybean side. Some big surprises there. And let's start at the top with corn. They dropped that bushel per acre down to 175.8. New crop ending stocks so down to 1.7 billion bushels. And that was a key area you and I were just chatting about before we jumped on here. That's a very big surprise there.
Well, that's it. I mean, when you think about where we were, as we were mentioned before we got recorded, we had a 2.7 billion bushel corn carry out, folks. That's what the government was telling us in August. And here we are in November. We're now down to 1.7 billion. It's a combination of two things. The first one is yield. Yield is dropping. I think this is the first report we've ever had where no state saw an uptick in national yield. I think North Dakota was down 15 bushels. So we did have the downward revision in yield. But the big thing was the demand. The demand has been fantastic. A lot of it has to do with China. The government has been kind of lagging. The fact of the matter is, Jesse, they've been saying China was only going to import 7 million metric tons. We've sold them over 10, 11 already. They finally came clean, or partially clean, I should say. They raised the China imports to 13 million metric tons. So the combination of raising demand and export demand, lowering yield, voila, we got a 1.7 carryout, and that's some of the tightest carryouts we've seen, I believe, since the 2013-14 marketing year, if it ends up that low.
Yeah, and it's good news into the markets today. Futures trade, we're up 13 to 15 cents on a lot of contracts. That December contract sitting at 423 at the close, up 15 and a half. You look at March 431, May 434. So a nice jump there in corn futures. And if I'm a producer sitting on some bushels, it's got to be a lot of opportunity for profit taking here with corn now.
Well, there is, and that's why we remind a lot of producers out there. This has been one hell of a roller coaster year. Back early winter, Jan, Feb, March, the spreads were narrowing, the basis was strong. It looked like we were off to the races, and of course, the pandemic hit. And the market broke hard. Then everybody was thinking, oh man, how am I going to make money? Now we're back to profitability levels nobody really probably ever thought. We're encouraging people to continue to reward the market. There is a lot of uncertainty with the pandemic. China demand has been good. Let's face it, Justin. We never know if they're actually going to take delivery of all this grain they bought. So reward the market. That's what the market's for. Option play. You want to play the what if China does buy 20, 30 million metric tons. Consider buying like a July option strategy to maintain some ownership on whatever bushels you sell.
Yeah, and you think about it, just, put some floor underneath you, get out there and take some of this profit if it benefits your bottom line. Obviously, everybody's a little bit different, but, I'm looking at these futures numbers and then obviously, see how that translates to the cash side. But again, just a great day for corn that was highly unexpected, Jim.
It was. And like you said it best, I mean, producers, do your balance sheets. Talking to people, it's really kind of interesting. We work with a lot of cash merchandisers. Our partner firm is John Stewart Associates. They were saying was really interesting, Jesse. The guys in the East, in the Eastern Corn Belt, tend to be aggressively selling corn right now. They're selling it. It's interesting for your producers who are listening on this podcast in the West. It's a lot of DP corn, interesting enough. So the guys in the West are defer pricing it. The guys in the East are selling it relatively aggressively, it sounds like. I would expect to die down a little bit. And then as we flip into 2021, I would expect more sales to kick in, plain and simple. We have a lot of customers that they literally don't want to sell any more grain. They don't want any more revenue. So we expect the basis maybe to weaken, I would say, at the beginning of 2021 as farmers start to open up the doors when they can kind of get that new tax year.
What do you think's the reason there's more selling going on in the East versus the West right now? I've noticed basis, obviously, for a while. It's there's been a difference there. Basis has been a little bit weaker in the West, a little stronger in the East, it seems. Is that kind of the main reason you're seeing that, Jim?
It's primarily the basis in the East is definitely a little bit stouter. I think the crop's a little bit bigger. Iowa had that problem with the derecho, so that kind of tightened the basis. And a lot of producers think if I hold tight, I'm going to get a higher price, 3, 4, 6 months down the line. The guys in the East, yields have been pretty good, and those, I think, as we're running out of storage, they're moving. I mean, heck, when you're looking at the price of corn today compared to where it was just 30, 60, 90 days ago, a lot of guys are just choosing to take the money and run.
Sure. Let's switch over to soybeans. USDA lowered its production estimate for beans by 98 million bushels in the November WASDE to 4.17, lowered the average national yield to 50.7. And, despite there's some rising interest out there from China again on the soybean side, but the change today didn't come from exports. It was that lower production estimate, Jim, and we saw the market, up 30 some cents on most of these contracts, and now sitting within striking distance of 11.50 on the futures in soybeans.
Well, that's it. And that's what you pointed out, Jesse, is really, I think, important in the long run. This revision was all on the supply side of the equation. And that brought us down to a 190 million carryout. Now, folks, remember, the tighter that carryout gets, the more downward revision it gets a little bit more bullish. Now, we will not get a revision of production in December, but we will have one more final crop revision potentially in January that could be a little bit more friendly. But the big thing is China's been very, very aggressive buying beans. And a lot of people thought, including ourselves, thought you might see that demand number increase. They didn't do it, which tells me down the line, we are going to see more demand revisions to the upside, and that will be bullish. And I think that leans to argue more than likely that carryout is going to continue to drop. And I don't think it's a matter of if, I think it's a matter of when we hit that $12 bean target.
Yeah, and a lot of producers looking at this saying, hey, maybe it is possible to get some $12 beans depending on how things go. But again, I think it's the same situation here in beans, Jim. If you got a spot to take some profit here, or at least lock in something for now, it's probably a good idea.
I would almost encourage people to be a little bit more aggressive selling beans than corn, simply because you look what the market's telling you. There is a corn carry in the market. The market is paying you to store some of this corn or hold it. If you look at the bean spreads, the price of beans from Nov to Jan to March, there is no carry, and it's actually inverted, folks, which is pretty much saying they're penalizing you to store those beans into next year because you're making a huge bet on what's going to happen in South America. Right now, we're selling a lot of beans to China. We're loading those beans out to China. China takes delivery of these beans now through the beginning of the year. And the risk is if you hold on too long and get too greedy, and then all of a sudden China says, wow, I've got a big crop I can essentially get from South America. And politically, we have some toughness going on in the United States and China. They could cancel a beans purchase or two, and you don't want to get caught in that mess. So the argument would be to continue to move the beans, lock in the profit. And if you want to play the what if of South America, use option strategies. And I want to stress, Jesse, there is a what if. We are in La Nina. Historically, La Nina, Brazil has okay crops, but Argentina tends to have a yield drag. And what the carryout is tied as it is any one of those countries has a yield problem, it will exacerbate the problem and it'll force China to buy our beans, which could very be a bullish situation, plain and simple, down the line. Even more bullish than it is now, I should say.
Yeah, and you mentioned that weather drag possible in Argentina. We did see USDA production. They dropped that 1.5 million metric tons to 51 million metric tons. No changes in Brazil in their production estimate there on the WASDE report. But again, that's a great point you bring up, Jim, about that. And just looking overall at this quartered soybean market again, just seems like some unexpected news today on the goods side. It'll be curious to see how we go throughout the rest of the week, though.
It will be. I mean, I think if you would have asked traders, a 1.7 carryout corn would be limit up in the corn market. We actually didn't even take out the near-term high at the onset of the number. We pulled back a little bit and then made a surge higher. I would expect that you're going to see this market slow down. We are a little bit overbought. The supply, I would say right now, our supply news is now moved away from us. Like I said, we do get a a December WASDE report, but they make no production revisions. The next one will come in January. South America is just beginning to plant. So you can't really expect them to revise their crop dramatically right now. So it's all going to come down to demand, folks, at this point in time. Can we continue to see the Chinese demand keep going and foreign demand? If the demand kind of stalls out a little bit, with the market getting a little overbought, the funds long all this stuff, it would not surprise me to see a little bit of profit taken as we go into the holidays. Thanksgiving is upon us. and then you move into the Christmas season, it would not, like I said, don't be shocked if the market slows down a little bit, but don't take, like I said, like Jesse mentioned, lock in profits here, folks. If you got any questions, give us a call. We'll be able to help you out as a way to re-own it.
Yeah. Let's shift over to wheat, Jim. And wheat, really no big changes in the USDA report today for wheat, but they kind of rode the coattails of the corn market a little bit, and we saw some higher closes in Chicago, KC wheat, spring wheat as well. What are some things you've seen in this wheat market? We've been talking weather has been the big thing the last few weeks.
The weather's been the key. We've been dry in parts of the Midwest, or plains, as well as Russia and Ukraine have been a little bit dry. That's going to start moving off the table. Good, bad, right, wrong as we go into dormancy. The wheat market, I think, will be the follower. As corn and beans continue to pull up, it will pull the wheat up a little bit. But right now, this market, plain and simple, is all going to be on the corn and the beans, I got to believe, at this point in time.
Yeah, very true, and some things to watch there. Let's shift over to livestock, Jim, and today, pretty quiet day there. Hog side, we were down a little bit today. Not really a lot of activity in the hogs. They're still kind of hovering around that 65, 70 range. A lot of people, I've heard differing opinions on this hog market right now. What is your take on where hogs stand?
I think the livestock sector in general is in a really weird dynamic right now. With this COVID crisis expanding and really ratcheting up right now, you're seeing a little bit more hoarding. A lot of people are talking kind of like we're starting to see what we saw in the spring, where people are being a little bit more aggressive, going to the grocery store, being a little bit more, buying a little bit ahead of time. Countries are getting a little bit more hoarding. So I think that could be a little bit near-term friendly as this market does try to, pull up some near-term demand. But we got to be careful, like on the livestock, especially the beef, the live cattle. We're back up to contract, near-term highs actually. Profitability's there. I'm a little bit hesitant to get really bulled up at these levels, especially on the cattle. Producers are essentially that are feeding livestock. If you're in levels where you can lay off risk profitably, I would encourage you to consider it. The fact of the matter is, we got some great news yesterday on this vaccine out of Pfizer. But the reality is, it's going to hit maybe the healthcare workers and maybe the very weakest people in nursing home first. That's going to hit the market maybe at the end of the year, early 2021. The reality is, folks, it'll probably be more like Memorial Day weekend, even July 4th weekend, before the general public really gets these vaccines. I do think once we get through that, you're going to see a relief rally where demand, or people just want to go out and spend money, go out to eat. But the near term, we've got hospitals that are hitting capacity, and that's got to be a little bit nerve-wracking. I know a lot of people in the livestock industry are just nervous as all get out. Is can these packing plants dodge the bullet, the problem they had earlier this spring, and when they've got to slow down these lines because there's just not enough people to handle, the capacity due to this COVID expiring or racing around. So if you can lock in profits, it's probably a smart thing to do right now.
Yeah, and you mentioned, on the beef side especially, I've been watching the countryside lately, and despite us, kind of edging higher and a decent run up here the other day, this cattle market, we just can't seem to get a bid out in the countryside. Nothing out there today. Be curious to see what we have tomorrow and Thursday, but it's been tough to kind of get up to some of those levels right now.
Well, right now it is. And like I said, it's, we're in a weird situation. Like I said, I think this whole industry is just very, very leery about what's going to happen the last 60, 90, 120 days with this COVID crisis. No one wants to get caught owning a bunch of livestock they can't kill, plain and simple. But they also don't want to get caught not being able to feed that demand to the grocery industry if we have this huge run. So it's just a very complex issue. And when we get in that kind of complexity, I like to encourage producers to fall back to what matters. Can you or can you not make money? If you are making money, sometimes you got to say, how do I lay off that risk and make sure I'm here to thrive 6 months, a year, 2 years down the line? Like I've been pointing out to my customers all year long, it's been one hell of a roller coaster. Like I said, March looked good. The summer looked devastating. Now we're back to profitability. You don't want to ride that hill back down if you don't have to, plain and simple.
Yeah, and a lot of great points there that you make, Jim. And again, obviously there's plenty of risk out there, and it just depends on how much risk you want to take, no matter what you're trading right now, whether it's in the grains or in livestock.
The risks are immense, but that's one thing that's exciting about it, though. Without the risk, you don't get the profitability. And right now, we talked a little bit, Jesse, all the old crop, but look at new crop, folks. Something to consider. You've got new crop beans up near 1050. You've got new crop corn up around 405. Keep an eye on that, folks, because we don't know what's going to happen 6 months from now. I know a lot of people don't like to sell 1050 beans when they're looking at 1150 beans for the new crop. But if you remember back in 2012, in the drought year of 2012, the spot corn got up to $7, $8, Jesse. The back months never got close to those levels. But if you were a hedger and you were selling some of that back month corn, it was some of your most profitable sales. So even though the market's not as high as a spot, if those numbers are profitable in the back end, do not be afraid to hesitate to start locking in. If you sold 10% of your corn producers at 405, 415, or 10% of your beans at, let's say, 1050, and that is your worst sale, I'm telling you, you're going to have a very good year more than likely, and you'll be very happy.
Yeah, and I think that's what it all comes down to is being happy and trying to find as much profitability as you can. And that's a great point that you make, Jim. Just in general, looking over this market again one more time here today, anything else that you would want to put out there to producers listening in on just some things they need to watch or any signals here as we wrap up a WASDE report day?
Well, right now, I think the real signal right now, overall, I would say is they're going to be very simple. We start taking out this week's lows technically. That would be a negative sign. I'm going to stress, I don't anticipate that happening. But if we would start to see that, that would definitely be a red flag. I mean, technically speaking, when you look back, I think, when beans take out 10, they tend to make a move to 11. So I think 11 is a legit target. And I would guess that we get a decent shot. We'll see 450 corn eventually with these numbers. Like I said, it's been a long time coming. The government gave us a bullish number on both numbers, and let's enjoy it.
Yeah, and we'll have to see again. That January report's going to be the one to really watch here as we move into the holiday season. And obviously, again, you mentioned COVID a couple times. Depending on where that goes, that's all going to factor into the markets. But a good day nonetheless here after this WASDE report. Jim, if folks want to reach out to you and the team at agmarket.net for a little advice, a little help with their marketing, what's the best way to do that?
They can reach the team at 844-424-6758, or they can go to our agmarket.net webpage, or they can download our app at the web stores, either the Google Web Store as well as iPhone Web Store.
Making it very easy. The guys at agmarket.net. Jim McCormick, appreciate you joining me here on Market Talk today. Thanks so much for the time. We'll talk again soon.
Thank you for having me.
Jim McCormick with agmarket.net, our guest today here on Market Talk. This has been the Tuesday, November 10th, 2020 edition of Market Talk. You can find us online, markettalkag.com, on Facebook, Twitter, and Instagram at Market Talk Ag, and find us on your favorite podcast sources, including Spotify, Apple Podcasts, iHeartRadio, and more, and also our radio affiliates, including KMA in Shenandoah, Iowa. This has been Market Talk for Tuesday, November 10th. I'm your host, Jesse Allen. Have a great afternoon.